I think we've got enough people to start. So hey, everyone, and welcome. I'm Jonathan Hobbs, and I'm joined today by my colleague Violeta Todorova. And today we're going to talk through how options exchange-traded products aim to generate monthly income. Some quick housekeeping rules before we start. If you have a question at any point, please feel free to drop it in the Q&A panel. That's a separate one to the chat box, and we'll get to it at the end. We'll walk through them in the order that they come in. The session will probably run for about 45 minutes with around 10 minutes for Q&A at the end. We do have the session for an hour. We are recording it, so if you do need to drop off at any point, you will still get the replay afterwards. A quick disclaimer before we go on. All views, statements, and opinions are solely those of the authors and do not represent those of Leverage Shares or its affiliates. That's including IncomeShares, and Leverage Shares and its affiliates do not endorse, confirm, or accept any responsibility or liability for the accuracy, completeness, or consequences of any of this information provided. So with that out the way, we'll just get into the agenda. And we're going to cover a few different things today. First, we're going to start off with the investment case for options exchange-traded products. We're then going to, or Violeta is going to then explain some of the strategies, so the covered calls and the cash secured put plus equities, and the theory behind those and how they work in different market conditions. And then I'm going to go ahead and talk about the covered call strategy, performance analysis along with a case study, and then cash secured put plus equity performance analysis in different market scenarios. We'll then do a quick new product overview at the end, as we did launch 35 new products over March and April, and then we'll have a Q&A to finish things off. So I thought I'd start this presentation with a quick chart of the S&P 500 dividend yield over the past 150 years or so. You'll notice that the dividend yields have trended down in recent history. Back in the day, the US stock markets paid between 4 and 8% in dividends per year, but those days are obviously long gone. Looking at this chart, the dividend yield was 1.04% as of yesterday on the S&P, which is actually the lowest dividend yield ever recorded for the index, and even lower than the dot-com bubble record. So the real issue here is stock market concentration. Tech now makes up about 35% of the index, and the bigger names, so Nvidia, Microsoft, Alphabet, those companies pay little to no dividends depending on their market size. The dividends across the pond in Europe and the UK are a little bit better. The stocks Europe 600 yields about 2.4%, and the FTSE about 3%. So they are better than the US, but it still doesn't really keep up with inflation. So we have this problem today for income investors, and it's not just with stocks. With real estate, you can buy a property and rent it out, but that's actually a lot of work and not really passive. If anyone's been a landlord, you'll know that. There's management costs, there's upkeep, and there's dealing with agents and tenants, and it's also not liquid in a down market. Commodities tend to work well for diversification and inflation protection, but they don't pay any income. Bonds, on the other hand, these are loans to companies or governments that pay interest. They can produce fixed income through coupons, but if interest rates rise, bond prices can drop, and the income might not always cover the capital loss. And anyone who's bought TLT, the iShares 20 plus year Treasury bond ETF, maybe in 2020, knows all about that, as the price has come down quite substantially. So this brings us to the aim of IncomeShares. We essentially are trying to help tackle the passive income problem in today's markets, and we offer exchange-traded products, or ETPs, that aim to pay investors monthly income by selling options on various popular assets, and that includes everything from gold to single stocks like Nvidia and MicroStrategy. The goal here is to make income-focused investing more accessible, transparent, and cost-efficient, and this involves 3 steps. The first is to sell those options on popular assets. And then step 2 is to collect payments from selling those options, called premiums. And then number 3 is to distribute said premiums on a monthly basis to the investors in the ETP. So income is the main story of these products, but it's not the whole story. There is a combination that we like to look at in terms of growth potential, income from selling options, and then some some downside protection from the premiums that you receive. So another way to look at it is IncomeShares can be somewhere in between growth stocks and dividend stocks. Growth stocks give you upside but little income. Dividend stocks give you income but not as much growth perhaps. So we aim to offer something somewhere in the middle by holding some exposure to the underlying assets themselves and then also paying the income. And then before I hand you over to Violeta, I just wanted to go through this chart, which shows the total assets under management of IncomeShares over the past 12 months. At the end of April, we were at 165 million in assets under management, and that is still relatively small compared to other big issuers, but it is up 3.5 times over the past year, which does show the growth. And I think as of yesterday, we're somewhere around 180, or that's not confirmed as of the end of the month. So that's it from me. Violeta, over to you.
Thank you very much, John, and a very warm welcome, everyone, to our webinar. So let's go through the theory, and I hope by the end of the session you will have a good understanding how our products work. So the IncomeShares line of exchange-traded products are designed to produce monthly cash flow through two main strategies, covered calls and cash-secure puts, which generate yield from volatile assets like tech stocks, commodities, and treasury bonds. These investment tools are intended for professional investors and carry risks, including the potential for capital loss. Ultimately, these ETPs are a modern solution for those seeking passive income beyond the traditional dividends or rental properties. Both covered calls and cash-secure puts generate income primarily through the sale of options and collection of option premiums while retaining exposure to the price of the underlying asset. This is a central component of the IncomeShares strategy, which aims to sell options on popular assets and distribute these collected premiums to investors on a monthly basis. So the key components of a covered call strategy are a long position in the asset against which the fund sells call options. This generates income through the premium received from selling the call option while retaining exposure to the underlying asset price moves. The covered call is one of the most popular strategy among investors, and clearly the main objective of the strategy is to collect weekly premium. A cash-secure put works the other way around. The fund sells put option on a stock they want to have exposure to and keeps enough cash available to buy the shares if assigned. The strategy generates premium income upfront, and if the price of the underlying falls below the strike by the end of the contract, the fund might be required to purchase the stock at the strike price. Can we move to the next slide, John? Okay, and before we deep dive into how these strategies work, let's first examine what a call and a put options are and their characteristics. A call option gives the option buyer the right to buy a specified asset at a specified price during a specified period. Upon exercise of that right, the option seller is obliged to sell the underlying asset to the options buyer. A put option gives the option buyer the right to sell a specified asset at a specified price during a specified period. Upon exercise of that right, the option seller is obliged to buy the underlying asset from the option buyer. An option contract must relate to a clearly identifiable asset, for instance, a specific stock, index, commodity, a particular futures contract, a debt instrument, or foreign currency. This asset is known as the underlying asset. An option has a strike price or exercise price, which is the agreed price at which the underlying asset will change hands if the option is exercised. It is the price for which the underlying asset can be bought if the buyer of the option chooses to exercise its rights. At the time of deciding whether or not to exercise an option, the buyer will exercise it only if it is profitable to do so, meaning if the strike price is more favorable than the current price of the underlying. Such an option is described as in the money. A call option is in the money if the price of the underlying asset is higher than the strike price, while a put option is in the money if the price of the underlying is lower than the strike price. If exercising the option would result in a loss, the option then is said to be out of the money. A call option is out of the money if the underlying price is lower than the strike price. On the other hand, if put option is out of the money, if the underlying price is higher than the strike price. An option is at the money if the underlying price is the same as the strike price. The expiry date of the option, also known as maturity date, exercise date, or declaration date, is the last day at which the option may be exercised. The last element of an option is the premium. The premium basically is the cost or price of the option. It is the amount paid by the buyer to the seller. Let's now dive deeper into covered call and discuss what the strategy is, when it's best to use, how to set it up, and how to exit it. A covered call option strategy is designed to generate additional income. As we said earlier, the strategy involves holding a long position in a financial instrument while simultaneously selling call options on the same asset. The primary objective here is to earn premium from the sale of the call options, which can provide a buffer against potential future declines in the underlying asset's price. The potential losses are limited to the downside movement in the underlying asset's price, less the premium received from writing the call option. The strategy is considered covered because the option seller, or in our case, the IncomeShares fund, already owns the underlying asset, mitigating the risk of having to purchase the asset at a higher market price to fulfill its obligation if the call option is exercised. A covered call is a relatively easy position to establish. First, the fund buys the underlying asset, which is willing to hold for the duration of the options contract or longer. Once the underlying asset is bought, then the fund selects the call option to sell. Typically, one call option could be sold for every 100 shares of the underlying. The key consideration then is choosing the call option and what the strike price and the expiry date would be. The strike price is usually above the current market price or out of the money, and is the level at which the fund is comfortable to sell the underlying asset. The closer the current underlying price is to the strike price of the call option, the higher the premium will be. This is because the probability of a covered call becoming in the money, where the strike price is lower than the underlying price, and being exercised at expiration is higher. The expiration date is based on the investor's time horizon and market outlook. Expiration dates can range from 1 day to several months out. The further out is the expiration date, the higher the premium for the option, as it has more time to become in the money, and IncomeShares ETPs sell usually options with 1 week to expiry. At expiration of the call option, there are several scenarios for exiting the covered call, depending on whether the underlying price is relative to the strike price. The covered call can be established once the call option lapses. If the call option is out of the money and expired worthless, the fund simply sells another call. If the call is in the money and the underlying asset is called away, the fund easily sets up the covered call again by purchasing the underlying and selling a new call option. Next slide, please. Trading involves the risk of losing money and the potential to generate a profit. Options trading enable investors to change their risk-return exposure to the market. A payoff diagram usually illustrates the risk-return profile of market exposure, with the x-axis representing the price of the underlying and the y-axis representing the potential profit or loss. Visual representation of the profit potential is important to the overall understanding of an options trade. The payoff diagram in this slide simply illustrates how a covered call strategy combines owning a stock when selling a call option against that position and compares it with an outright long stock position. The shape of the payoff line demonstrates the trade-off between generating income and limiting upside potential. The diagonal blue stock-only line represents the return profile of simply owning the shares outright. As the share price rises, profits continue to increase without limit. However, if the stock price falls, losses also increase directly with the decline in the share price. The green covered call payoff line shows how the return changes once a call option is sold on top of the stock position. By selling the call, the fund receives an option premium upfront. This premium creates immediate income and slightly improves the break-even point of the overall position. In the diagram, this is reflected by the covered call payoff line sitting above the stock-only line initially. The strategy performs similarly to holding the stock until the price approaches the strike price of the sold call option. Beyond the strike price, however, the payoff line flattens. This flat section illustrates the key limitation of a covered call strategy. Upside gains become capped. Even if the stock continues rising strongly, additional gains above the strike price are largely surrendered because the investors have sold away part of the upside in exchange for the option premium. The shaded green area labeled option premium represents the income received from selling the call option. This premium provides partial downside protection because it offsets some losses if the stock declines. That is why the covered call strategy is often described as a defensive or income-oriented equity strategy. However, the diagram also shows that the investor still remains exposed to substantial downside risk if the stock falls sharply, since the premium only cushions a portion of the losses. Overall, the payoff diagram demonstrates the core trade-off of a covered call strategy. The investor sacrifices unlimited upside potential in exchange for upfront income and modest downside protection. So here is how the potential payout structure works for a covered call. The maximum profit is the premium received plus any stock gains up to the strike price. The break-even point is the stock purchase price minus the premium received. The maximum loss, if the stock falls to zero, will be slightly offset by the premium received. So in short, the covered call strategy provides some income or the premium and caps the upside potential at the strike price plus the premium received. It also offers a slight cushion against the downside move in the stock price, lowering the break-even point. Next slide, please. Okay. So the main benefit of a covered call strategy is the ability to earn income from selling call options. When an investor sells a call option, they receive a premium upfront from the buyer of the option. This premium is paid regardless of what happens to the market afterwards and can provide a regular stream of income. Covered call strategies are therefore often used by income-focused investors, especially during periods when markets are moving sideways or experiencing heightened volatility. The second benefit is that investors can still participate in the upside performance of the asset, but only up to a certain level, known as the strike price. If the underlying asset rises in value, the investor continues to benefit from those gains until the price reaches the strike level of the option sold. Beyond that point, the upside becomes capped because the investor may be required to sell the asset at the agreed strike price. In other words, the strategy sacrifices unlimited upside potential in exchange for receiving the premium income. The third benefit is the potential to reduce downside risk through the premium received. The option premium effectively lowers the investor's cost basis in the investment. For example, if an investor owns a stock at $100 and receives a $3 premium from selling a call option, the effective cost basis becomes $97. This means the asset could fall slightly before the investor begins experiencing losses on the overall position. However, it is important to understand that covered calls do not fully protect against significant market declines. The premium simply provides a modest cushion against losses rather than complete downside protection. Selling options generally provides a higher probability of making a profit compared to buying options. When selling options, investors receive an upfront premium, which is retained if the option expires worthless. Buyers, on the other hand, the longer they hold an option, the more likely it is to lose value, making it harder for the option to increase in price and yield a profit. The graph at the bottom of the slide compares the return profile of the overall market with the return profile of a covered call strategy. The blue line represents the market return, while the orange line represents the covered call return. In strong bull markets, the market return tends to outperform because covered call strategy have capped upside potential. In flat or moderately rising market, covered calls can outperform because the income generated from option premiums enhances returns. During declining markets, the covered call strategy generally falls less than the market because the premium received helps offset part of the downside. So overall, the covered call strategy smooths the market volatility. Next slide, please. Let's have a look at the risks from covered calls. Income paid out can reduce the ETP's net asset value or NAV. In the covered call strategy, NAV reduction occurs because the regular income generated from option premiums is paid out to investors rather than being retained within the fund. However, the reduction in NAV is a planned trade-off of the strategy. Investors prioritize immediate, consistent cash flow over the long-term capital appreciation of the fund's principal value. The other main risk from covered calls are the limited upside potential and the obligation to sell the underlying. The maximum gains at expiration are limited by the strike price. If the price of the underlying is at the strike price, the covered call strategy reaches its peak profitability. However, if the underlying price increases significantly above the strike price, the covered call strategy would miss out on the full upside potential. So the maximum gain for the fund, if the current price is above the strike price, is equal to the strike price minus underlying asset price plus the premium received. If the price of the underlying asset is above the strike price at expiration, the fund may then be required to sell the asset at the strike price. The fund could select a higher out-of-the-money strike price and preserve more of the stock's upside potential for the duration of the strategy. However, the further out-of-the-money call would generate less premium income. And finally, another disadvantage of the strategy is that downside risk still exists as the premium received provides only limited protection. If the underlying asset falls substantially, losses on the shares can easily exceed the option income. Next slide. So generally, covered call writing is most effective in a neutral to mildly bullish market environment. This strategy can enhance portfolio returns through the collection of premia and provide some downside protection. However, the strategy also limits the upside potential in a strong uptrend, where the price of the underlying asset could rise significantly above the strike price. In a strongly uptrending market, if the price of the underlying at expiration is above the strike price, such a call option is said to be in the money. In such situation, the covered call strategy will underperform the underlying and the fund needs to decide whether it wishes to sell the underlying or not. If the fund doesn't want to be exercised, the call option can be rolled out to the next expiration period and potentially at a different strike price. Generally, rolling options forward involves allowing options to lapse or closing out an existing call option and simultaneously opening a new call option with a later expiration date and potentially a different strike price. And this technique could be used to avoid the sale of the asset when the original call option is approaching or is at expiration and the underlying price is above the strike price. If the call is not rolled over, the option will be exercised by the option buyer and the fund has to sell the underlying at the strike price. In this case, the fund keeps the premium received and the gains from the rise of the underlying up to the strike price. Any movement above the strike price is forfeit. In a downtrend, if the underlying price has declined below the call strike price at expiration, the option will expire worthless and the fund would retain the underlying and keep the premium received from selling the call. Such a call option is said to be out of the money. The fund may incur a loss in its shareholdings position, which would be partially or fully offset by the premium received. If the underlying price has moved sideways and is the same as the strike price, such an option is said to be at the money. At-the-money options are rarely exercised by the buyer of the call. Therefore, the fund has a good probability of retaining the underlying asset and keep the premium. The maximum profit potential from the strategy is if at expiration the price of the underlying is at or close to the strike price of the call option. Next slide, please. The cash secure put plus equity strategy aims to earn income from selling put options while holding some exposure to the underlying asset. Each ETP combines two parts: 25% equity exposure by holding actual shares and 75% cash secured put exposure by selling in the money put options. The equity exposure gives the ETP some upside potential if the stock price rises. The cash secure put part means the ETP sells put options to potentially generate income while holding enough cash to buy more stock if needed. The put options used in the strategy are generally in the money, meaning the strike price is above the current share price. In the money put options have extrinsic and intrinsic value, which is essentially unrealized profit, and that's the reason why the fund buys in the money, sells in the money options. So the ETP collects more income upfront when it sells in the money puts. If the underlying price falls below the strike by the end of the contract, the fund may be required to buy the stock at the strike price. In return, the fund collects an option premium upfront and potentially buys the asset at a lower price. So here is how the potential payout structure works for a cash secure put. The maximum profit is the premium received if the stock stays above the strike price. The break-even point is the strike price minus the premium received. The maximum loss is the stock would fall to zero. If the stock falls to zero, then the loss is offset slightly by the premium. So how are covered calls and cash secure puts similar? Apart from having similar looking payout diagrams, both option strategy aim to generate income, involve selling options to collect a premium upfront, and can limit the ETP's upside and expose it to the downside if the underlying asset drops. They are both used in income share products depending on the asset class and market conditions. However, the majority of the ETPs used are using a cash secure puts, which in a way is considered a more advanced strategy as it allows the ETP to capture bigger upside in a rising market. Next slide, please. The main benefit of a cash secure put strategy is the ability to generate income while waiting for opportunities to buy stocks at more attractive prices. By selling a put option, the fund receives an option premium upfront, which creates income even if the stock does not move significantly higher. Another major benefit is the ability to potentially acquire quality stocks at a discount. If the stock price falls below the strike price and the fund is assigned the shares, the premium collected reduces the effective purchase cost of the position. As a result, the fund may enter the stock at a lower net price than if it simply purchased the shares outright in the market. Another advantage of a cash secure put is that the strategy reduces the downside risk by the premium received. Overall, cash secure puts can provide a combination of income generation, improved entry pricing, and a structured method of accumulating long-term positions. Next slide, please. One of the risks of a cash secure put ETP is that income distributions paid to investors can reduce the fund's net asset value or NAV. When the ETP distributes option premium income, cash leaves the portfolio and is paid out to shareholders. Although investors receive regular income, the assets remaining inside the fund decline by the amount distributed. Over time, especially during prolonged weak or volatile market conditions, repeated distribution can slow capital growth and contribute to NAV erosion. Another important risk is that the ETP may need to buy shares at the strike price if the underlying asset falls below that level. In a cash secure put strategy, the fund sells put options and receives premium income in exchange for taking on the obligation to purchase the underlying shares if assigned. If the market price drops below the strike price before expiration, the ETP may be required to buy the shares at the higher agreed price, even though the stock is now trading lower in the market. Losses can still occur if the underlying asset price falls significantly. While the option premium collected provides a small buffer against declines, it doesn't fully protect the portfolio from large downward moves. For example, if an ETP receives a 2% premium, but the underlying stock falls by 15%, the strategy still experiences a substantial net loss. In severe market downturns, the losses on the purchased shares can outweigh the income generated from selling puts. This means cash secured put strategies are generally considered moderately bullish strategies rather than true defensives or capital protected investments. Next slide, please. A cash secure put strategy tends to perform differently depending on the direction and volatility of the equity market because the strategy combines option premium income with potential obligation to buy shares at a predetermined price. In a bull market, the strategy will generally produce positive returns, but it may underperform a fully invested equity portfolio. This happens because the investor earns income from selling put options, but may not fully participate in a strong market rally if they're holding significant cash while waiting for potential assignment. If stock prices continue rising, the sold puts may expire worthless and the fund keeps the premium income, but the gains are usually smaller than the returns from directly owning the shares throughout the rally. In a bear market, the strategy will likely outperform, but still can experience losses because falling stock prices increase the likelihood that the fund will be required to buy shares at the strike price. The option premium collected provides a partial cushion against declines, helping reduce losses compared with buying shares outright at the start of the period. However, if the market falls sharply, losses on the underlying shares can still become substantial and not outweigh the income earned from selling puts. The strategy often performs best in flat, range-bound or choppy markets. In this environment, stock prices move sideways without large upward or downside swings, allowing put options to expire worthless more frequently. The fund can repeatedly collect premium income without needing to purchase the shares, which can improve overall returns relative to simply holding cash or owning non-moving stock position. Overall, cash secure puts are generally considered moderately bullish strategies. They tend to benefit from stable or gradually rising markets, provide some downside cushioning through premium income, but may underperform in strong rallies and still remain exposed to losses during major market declines. So I hope all this theory gave you enough clarity on how income shares option strategies work. Now back to you, John.
Thanks, Violeta, for that comprehensive breakdown of the theory. I'm now going to run through how this works in practice with some performance slides and case studies to show real examples of this. We'll look at bull market scenarios with gold, a range-bound market scenario with TLT, and then a bear market scenario with MicroStrategy, and how our ETPs performed versus the underlying investments. So starting here with gold, this is the gold plus yield exchange traded product. That's ticker GLDI, and that trades in US dollars on the London Stock Exchange. And this runs a covered call strategy on the Spider Gold Shares ETF, which is ticker GLD. So essentially, which tracks the price of gold. This started on the 23rd of July, 2024, which was actually when we launched IncomeShares ETPs. And the data on this chart runs through to the 30th of April, 2026. Now, as Violeta mentioned, in a bull market, these strategies, because you are essentially giving upside away by selling stock if it goes above the strike price, they can underperform to the upside in a strong rally. So over here, you have three lines in the chart. You've got GLD, which is in black, which is the underlying ETF, the price of gold, basically. Then GLDI plus income reinvested into the fund. And that was at 74% versus the 90% for GLD. So still a good return, but not quite keeping up with it in a bull run. The GLD price alone, that's when you don't include the income. So you just have the GLDI price that is without any income, that went up 40%. So obviously the difference between adding the income and reinvesting it versus no income does count for a lot. But if you look at the volatility with this strategy, GLDI had lower daily standard deviation, which just means lower volatility, and the maximum drawdown, which is the worst case loss if you bought at the worst time and then sold at the worst time over the period, was slightly less for GLDI, meaning it didn't have as much of a drop. The annualized yield, so this is 10.92% over 12 months. Basically, that is just less than 1% per month on average. And the income on a $10,000 investment over those 12 months would have been roughly $1,092 in this example. Now, the other thing that Violeta discussed was downside behavior when the price of an investment goes down with a covered call strategy. So in this case, we have an example of GLDI, the gold plus yield ETP, and actual trades that we did at the time. I don't know if you remember earlier this year, gold had a pretty big sell-off, started around 29th of January, carried on till 6th of February or so. And we ran options cycles. So we run a weekly options cycle, and this one went from the 30th of January to the 6th of February. These candles over here is the price of GLD, which is the underlying asset. And then over here, you can see where we sold two lots of options. One lot on the 30th of January, at 506 strike price, and then a $498 strike price. And just note that these strike prices were quite high above the actual price of GLD itself. So they were out the money. And then over here on the 2nd of February, we also sold a further two lots of call options. And that was the strategy and how it ran. And then this is these are the results of that strategy. So this table shows the premium that we collected, this column over here, the fourth column, and that's what you collect up front from selling the options. And then the premium we paid to close the options, so you have to buy them back, and that is the value over there. And the difference between the two, the profit will be higher when you collect more premium than what you have to pay to close it. So the first two lots of options, we made a $1.03 and a 68 cents profit per contract. Then on the third option, it was a 31 cents profit per contract. And by this time, the price of gold had dropped a bit more, so the options weren't fetching as much on the call side. But then on the last one, we did have a small loss of 7 cents. And obviously, you're not going to get all trades right. The name of the game is to try get more right than wrong, as with any trading strategy, and generate income and returns over time. So this diagram here just shows the daily price moves of GLDI and GLD during that sell-off from the 29th of January. And yes, GLDI did drop, the options ETP, but it didn't drop as much as GLD over the period. And that was due to the strategy itself and the nature of it, with the income providing a potential cushion. At the worst case scenario, GLDI was down 10.63%. That was at the trough, the 2nd of February, and GLD down 13.87%. And by the end of the weekly option cycle, still a little bit above. So GLDI was at 6.92 versus GLD at 8.15%. So we can now move on to a range-bound market, and these tend to be decent environments for covered call strategy. And you can see over here, we have TLT Y, which is our 20+ year Treasury Options ETP. And this runs a covered call strategy on the iShares 20+ year Treasury Bond ETF, which holds US Treasury bonds with maturities of 20 years or more. And this started on the 27th of June, 2025, which is when we launched the ETP. And that data also runs through the end of April, so last month. It's worth noting that the iShares underlying ETF does actually pay income itself, because it does hold treasury bonds, and those pay bonds from coupon or income from the bond coupons. And that did have an annual yield, annualized yield over that 10-month period of 4.59%, which on a $10,000 investment would have got the investor around $377 as an estimate on that. TLTY, however, because it also sells call options on the underlying, it adds an additional layer of income, and it had 11.82% over those 10 months versus the lower on the TLT, and that would have come to about $985 on that 10,000 investment over 10 months. Total return basis, so when you reinvested the income back into the options ETP, so TLTY, it produced 3.21%, so this orange line, which beat the TLT, which is the underlying with income reinvested, at 0.68%. Obviously, the blue line shows that it actually went down, which is the options ETP without the income, and that's normal, because as you're paying income away out of the fund, you're actually reducing the NAV. So a lot of the returns from this come from the income, and it's about taking the holistic approach of the total return and weighing that up. The next one is a bear market scenario, and here you can see MicroStrategy. Now, anyone who's held the stock during this bear market knows that it's dropped a lot, and here we are measuring it using a cash secured put plus equity strategy on MicroStrategy, which is our MicroStrategy Options ETP. That also started on the 27th of June, 2025, which is when we launched it, and the data again goes to the same period, end of April. Now, MicroStrategy did drop 56.9% over this time. YMSC dropped too, obviously, but it didn't drop by as much. It dropped 51.73% with that income reinvested, and it did have a lower volatility and a lower maximum drawdown. The average annualized yield, you'll notice it's a lot higher on this particular product than it is for things like gold and TLT, and that's because it's a much more volatile asset, and it tends to behave differently for a different investor. The income on that $10,000 was $6,720 over that time. Obviously, paying a lot of that income, this blue line over here would have caused the NAV to go down quite a lot. So it really is by taking both things into account that you get the overall return, which is the orange line. So that's the performance. I just wanted to go over quickly just a bit more on IncomeShares and the products that we do offer. So we do have 54 exchange traded products. We are Europe's widest options ETP range, so we do have the most products in Europe, and we're listed on the London Stock Exchange in GBP and USD also, as well as in Europe on Xetra and Euronext Amsterdam in euros. We offer products across single stocks, various different themes, commodities, diversified baskets, and then other indexes like the S&P and NASDAQ and Eurostoxx 50, which we recently launched. These are the 35 new ETPs we did launch over March and April. We've branched out quite a lot in terms of the single stocks, and we're including a lot more AI and semiconductor names, and we've also branched into digital assets, miners, and other digital asset linked companies due to their volatility. We have also kept a bit more less tech in some of these. So, for example, Berkshire Hathaway and United Health, we've added those too. Commodities, we've expanded quite a lot. We did just have the gold and silver ETPs before, but we recently launched gold miners and silver miners and copper miners, which can all have a bit more volatility. And then obviously oil, as we know, does have more volatility lately, and options strategies with volatility, that they can generate additional income. The diversified baskets, so we did launch a few more of these. We've got a 60-30-10 multi-asset strategy, which has exposure to, I guess, stocks, QQQ, so the NASDAQ, and then TLT, and then a 10% in commodities. And this is basically based off of the 60-40, but we tried to apply it to an income approach. Then there's a 75-10-15, which we recently launched. This is a bit more growth focused. It's got a bit less in TLT, a bit more in commodities, and more in the stocks and growth stocks. And then, as I mentioned, we did launch the index options ETP for the Eurostoxx 50 as part of that. So that's it for this presentation. If you have any questions, please feel free to put them in the Q&A box, and then we can get to answering those. Thank you. Okay, I'm not seeing any questions. Violeta, do you see any?
No, I don't see any questions coming, John.
Okay. All right, guys. Well, thank you very much for your time, and we'll speak soon. We'll send the recording to you if you need it. And thank you, Violeta.
Thank you, everyone, for joining us today. I hope you found the webinar quite helpful.